Urs Peyer, Associate Professor of Finance at INSEAD. You were talking at the INSEAD Leadership Summit Europe, taking part in a panel on shareholder value. In that panel discussion, you made an interesting point that you hoped the crisis wouldn't end too early. Why?
For one thing, I think the crisis helps to weed out the weak. So if you think of it from a perspective of creating value for your shareholders, if you have the wrong targets, your wrong ideas, the wrong way of implementing shareholder value, then those are the firms that are going to die first. On the other hand, it also gives the regulators a bit more opportunity to bring home the point to every person or to the electorate to stay on the ball and actually try and pass the regulations that some people think are necessary to get the economy from not repeating the same mistakes again.
So are you saying that governments have not been making the right moves in terms of bailing out banks? Should they have let them go?
Ex post, always hard to say, but what we see is it hasn't gone to the extent that there's an early resolution of the issue. Things have gotten worse once governments have taken over banks. But from the 1930s, we understand that there is probably no other way than to somehow rescue the banking system. The banking system is something that works on trust. And if you don't have that, there's no way to re-establish it other than by having, for example, a government stepping in and saying, I'm guaranteeing everything, so you don't need to run to the bank and withdraw your money. Let me just guarantee it for you.
And lack of trust is at the basis, the root of everything at the moment.
The root, at least, of the banking crisis, yes. If you think about a bank, an early bank, what has it been or how did they evolve? You see that they are always in very nice buildings with very big coffers or whatever that show that it's a safe building. And that's what someone needs to see. If you bring $1 million, you want to make sure that that $1 million stays in a safe place. And so, you know, this instinct of us as depositors in the end is still the same. You need to be able to trust your bank with the money, otherwise you withdraw it. The banking system relies on that trust. It does not work otherwise. Banks, they get cash. What do they do with it? Instead of lending it out to others, they hoard it as their own cash. And so we went from an excess of $2 billion cash holding to $800 billion cash holding U.S. banks alone. And that's just a reflection of a lack of trust.
In terms of corporate governance, do you think that boards could have been doing more in terms of asking the right questions?
Absolutely, absolutely. So I think at the level of the company's failures, it is the board's job to ask the right question, to make sure they understand the risks taken, but also it's their jobs to set the right incentives for managers. And I think on both dimensions there were shortcomings. Think about just the excessive lending that was done to people who everyone knew they could not repay or repay at least with a lower probability. Still, managers were paid to do so because it generated the current earnings, and you didn't think about the earnings 2-3 years down the road. And so value destructive lending was essentially encouraged, and in part that's set by the board's measures in executive compensation, which breaks down to compensation at any level in the organization.
Do you think it's going to take a long time for governments to exit from banks, you know, having got in there and more or less nationalized them?
Right. So I think the consensus a little bit was in the panel that we don't know what the exit will be and look like. Is it going to be that they're there permanently? Is that one way of trying to stabilize the system, to have a permanent say? Or is it that they actually want to exit and leave it to the private sector again, but with heavy regulation on top of it? We don't know. We don't know. No one has an idea. No one has said anything about the intentions, what is necessary to get the financial systems really back on track and make it such that it creates most value for the economies again.
How do you think the financial sector will look after the crisis, after the downturn?
The hope is there is still a financial sector. What we do know naturally is banking is always necessary. We all want to bring and deposit our money somewhere, and we want to go and borrow from it. So commercial banking for sure won't change that much. There are some standards, and it's already heavily regulated, so I don't think there will be very much difference.
Will there be greater separation between investment banks and commercial banking again?
Yeah, so that would be my hope, and the hope basically comes from the fact that if you think about board members and their understanding of the business, commercial banking is one thing, investment banking is something else, and you really need to understand the risks taken by the investment banking. You can't just have it not understood because you understand one thing and not the other. And so separating it again will get you to have people understanding better what the risks are, and certainly get rid of the systemic risks that if an investment bank breaks down, it won't bring down the whole world.
How do you think we can get people on boards who understand these complex financial instruments?
First of all, they're not that complex. It's just someone has to ask the question, what the hell is going on? We teach this to our MBA students, and they go out, do regular jobs, and they get a glimpse of what is behind it. But there needs to be some form of a training to keep up with whatever new stuff comes along. And as such, I think INSEAD has a role to play in trying to push more for actual fundamental knowledge to be distributed among top board members rather than just the other stuff that's also important, but just leadership in that sense.
During the session, we had a few calls for greater transparency. Do you think that will end up being the case?
Yes, so there's some need to make it more obvious what kind of financial instruments there are. There has been people that work in the R&D environment or in the pharmaceutical industry said that, well, our products are heavily regulated. There is a regulator that says if it's FDA approved, and then you can use it. And so why isn't that for financial instruments that we have someone saying this is healthy for the economy? Indeed, we do have that, and that's called a mutual fund. And mutual funds are very heavily regulated as a financial instrument. Then there is the less regulated side, and the question is if it can harm the entire global financial system, maybe we should take a more careful look at how that is regulated.
And the hedge funds have come under a lot of scrutiny. To what extent do you think they were to blame, or are they essentially being treated as a scapegoat?
It's difficult to say. So we have heard some numbers in terms of balance sheet information that they were only a small fraction of investors. We have to realize that they actually do a lot of trading. So they make up a big chunk of the trading volume with limited amount of capital. And if you think about what a price is in the financial market, what is a stock price, who sets it? It's the marginal investor. That marginal investor is one that trades. And so as such, hedge funds are to a large extent among the price setters. And there is all of us that have invested in a mutual fund or in a pension fund who don't trade. Our stuff is not immediately reflected. We're sort of in the background and saying like, oh, at this price we're not willing to trade. So hedge funds indeed are the ones that are more often involved in price setting, and as such they have an impact on perception, on the firm value that people perceive there to be.
Is there a need for greater regulation, or is it
Good
sufficient
question.
so far?
Good question. Well, yeah, so whether zero regulation is a good thing to have. I think as long as they're outside of an investment bank, they're unrelated to something that has a systemic impact. These thousands of hedge funds, all they do is they create investment opportunities. They have a very strong opinion. They're willing to put their money where their mouth is. And that's good. That's good for the economy. It will help us weed through weak companies or weed out weak companies much quicker, because they're the ones that are actually saying, hey, I'm a shareholder. I put my money where my mouth is. I'm willing to short your stock because I think you're doing something wrong. Here is what it is. And my research is compensated by the fact that other people agree with me, and the price goes down. So I don't think that's generally an issue. In smaller stocks, we should always worry about those because smaller stocks are more liquid and they're more prone to be price manipulated. And as such, any sort of investor will have an incentive to manipulate and gain from it. Hedge funds are certainly part of those groups.
You mentioned shareholders there. The panel discussion was supposed to be looking at shareholder value, but focused very heavily on the crisis and the downturn. Yep. Jack Welch recently, former CEO of GE, recently said that shareholder value was, I think, quote, the dumbest idea in the world. Yep. What did you make of his views on that?
Yeah, so he's right, and that's sort of my point as well, that if you say maximizing shareholder value, what comes to mind is a good indicator for whether you have created shareholder value is looking at price, share price. If share price goes up, you've created shareholder value. That's sort of all very good and logical. Until you get to the point where you say, okay, so how do I get you as a manager, as a CEO, to maximize shareholder value? Well, if the outcome or the indicator is the share price, then how about I compensate you based upon what you do to the share price? So if you create value, share price goes up. This is your way of, my way of compensating you for your efforts. Good thing at the start, until executives figure out that you can actually manage the share price. The way it has been done in banks by just lending, as we mentioned before, lending to people who don't or can't be expected to pay back. But currently earnings will go up. Current earnings are used as an input to form the current price.
And you meet your targets or exceed them.
And exactly, and so what you will get is a management of the share price. But that's not what shareholder value is about, and that's what he says as well. Okay, so he's not against maximizing shareholder value. It's about how people turned it or incentivized executives on trying to implement maximizing shareholder value. Shareholder value is still, and has always been, about creating value for customers, holding or sort of looking at what your employees want, paying them a fair price, looking at all other stakeholders that have or don't have a say in it, and compensating your investors. If you cover all those costs with your revenues, and there's something left over, this is what is called shareholder value. And that is sort of the present value terms. It's not only in 1 year, it's all in the whole future years.
But isn't there an argument to talk about stakeholders rather than shareholders? And maybe we should be focusing on stakeholders, whether they are employees rather than just purely the people holding the stock at a particular time.
Absolutely. They're absolutely critical. Without a customer, there's no company. So that is a critical stakeholder. Without an employee, there is no sales, there is no company. So all of these stakeholders are crucial, and that's what management should focus on. Such that when you look at revenue minus cost minus capital cost, that what comes out is something that does create leftover value for the shareholders, right? Subject to. So when you start saying things like, okay, I'm just looking at the share price and I have to get that one up, I can do this by misinforming you about the future earnings potential of the firm. Share price will reflect that. It's very hard for the market to see through these kinds of lies and schemes.
Companies have been focusing probably too heavily on their quarterly results in terms of keeping the analysts' expectations under control.
Absolutely. So as long as if you just give a quarterly earnings expectation, then you feel like you have to manage your earnings to that expectation. Otherwise, they'll be disappointed. So very clearly, that's not the job of a CEO. The job of a CEO is simply to create value. If it doesn't quite meet your quarterly earnings, who the hell cares? Right? It's a reflection of the fact that you manage the business. In a year and in 2 years, it will be better. So the quarterly earnings stuff, I think, has also gotten a bit out of hand. And the need for managers to try and meet what their goals are, what the expectations are, have led to absolute misallocation of capital, have led to channel stuffing, internal sales. And everyone knows it in the organization, that there's something wrong that you just do to meet the quarterly earnings. People know it, down to our MBA students. They tell me this in class. We had to do this because we needed to meet the quarterly target. And when you come to the end of the analyst meeting, you just see, oh, I met my earnings. And no one gives you the reason for why you did meet this. And this is what the market hasn't, it's some form of asymmetric information, lack of knowledge about where that earnings really comes from, what that earnings number really means.
A lack of transparency.
A lack of transparency, and it will always be there. And so implementing maximizing shareholder value isn't something that's very easy to do, because you always have this asymmetry and sort of hidden information that the market will learn about over the years to come, but immediately has to make an assessment, and that might be wrong.
Urs Peyer, Associate Professor of Finance at INSEAD, thanks for joining us.
Thank you.